Whether you're new to the concept or looking to deepen your understanding, dividends play a crucial role in building wealth and achieving financial independence. Understanding this can significantly impact your financial journey. So let's break it down and explore everything you need to know about dividends. Dividends are a portion of a company's profits distributed to its shareholders as a way to reward them for their investment. When you own shares in a company, you essentially own a portion of that company, and dividends are your share of the profits. These payments can be made in cash or additional shares of stock. Cash dividends are the most common, where shareholders receive a specific dollar amount per share owned. On the other hand, stock dividends increase the number of shares you own, but don't change the total value of your investment. Dividends are typically paid quarterly by most U.S. companies, although some pay them monthly or annually. Companies decide on their dividend policy based on their financial performance and growth opportunities. Investors often see dividends as a stable source of income, especially when compared to the potential volatility of stock prices. However, it's essential to note that not all companies pay dividends, especially younger, faster-growing companies that prefer to reinvest their profits to fuel growth. Understanding how dividends work can help you make informed investment decisions and achieve your financial goals. Companies pay dividends for several reasons, each reflecting their financial health, growth stage, and shareholder expectations. Understanding these reasons can help investors gauge a company's stability and management's priorities. Firstly, dividends are a way for companies to reward shareholders for investing in their business. By paying out a portion of their profits, companies attract investors who seek regular income. This can help stabilize the stock price and reduce volatility, as dividend-paying stocks are often seen as less risky. Secondly, dividends signal financial health and management confidence. Companies that consistently pay dividends demonstrate their ability to generate steady profits over time. A reliable dividend history can attract long-term investors who prioritize income and stability. Moreover, dividends are a form of corporate governance. The decision to pay dividends is made by the company's board of directors, who must balance the interests of shareholders with the company's growth prospects. In mature industries or companies with limited growth opportunities, dividends may be a way to distribute excess cash to shareholders rather than reinvesting it in the business. Another reason companies pay dividends is to maintain shareholder loyalty. Regular dividend payments can build trust and satisfaction among investors, encouraging them to hold on to their shares for the long term. This can help reduce turnover and support a stable shareholder base. Lastly, dividends can have tax advantages for investors. Qualified dividends are taxed at lower rates than ordinary income, providing a tax-efficient way to generate income from investments. Overall, understanding why companies pay dividends can help investors assess the financial strength and long-term prospects of a company before making investment decisions. Now let's dive into the different types of dividends. Understanding these will help you make smarter investment decisions and manage your taxes effectively. First, there are cash dividends. These are the most common type where companies distribute a portion of their earnings directly to shareholders in cash. It's like getting a paycheck from your stocks. Another type is stock dividends. Instead of cash, companies pay out dividends in the form of additional shares of their stock. For example, if you own 100 shares and they declare a 10% stock dividend, you get an extra 10 shares. This doesn't immediately increase the value of your investment, but adds to the number of shares you hold. Now let's talk about qualified and unqualified dividends. Qualified dividends are taxed at lower long-term capital gains rates, which are generally more favorable than ordinary income tax rates. To qualify, you usually need to hold the stock for a certain period before and after the dividend is paid. Unqualified dividends don't meet these criteria and are taxed at ordinary income tax rates, which can be higher. Understanding these tax implications is crucial. It can make a big difference in how much you keep from your dividends after taxes. Your brokerage statements will indicate whether your dividends are qualified or unqualified, and companies will usually specify this in their dividend announcements. Lastly, there are special dividends. These are one-time payments that companies make in addition to their regular dividends. They're often larger and happen when the company has extra cash, like from selling a division or getting a big profit. Knowing these types of dividends helps you choose investments that align with your goals and tax strategy. It's all about getting the most out of your investments while managing your tax bill effectively. Understanding how dividends affect stock prices is essential for investors looking to maximize their returns. When a company announces a dividend, it can lead to changes in the stock price. Before the ex-dividend date, the date when new buyers of the stock are no longer entitled to the dividend, there's often an increase in demand for the stock. This demand can drive up the stock price. This is because investors who purchase the stock before the ex-dividend date will receive the upcoming dividend payment. Conversely, After the ex-dividend date, the stock price often drops by approximately the amount of the dividend paid. This is because the dividend payment reduces the company's cash reserves, which can impact its perceived financial health. Additionally, new buyers of the stock after the ex-dividend date won't receive the current dividend, so they may be less willing to pay the previous price. However, it's important to note that dividend payments are just one of many factors that can influence a stock's price. Factors such as company earnings reports, economic conditions, and broader market trends also play significant roles. Interestingly, not all investors are primarily concerned with dividends. Many growth-focused investors may prioritize a company's potential for capital appreciation over its dividend payments. This can result in divergent reactions to dividend announcements. Moreover, dividend-paying stocks can attract a particular type of investor, those seeking stable income and less volatility. This demand can provide a floor under the stock's price during market downturns, as these investors are less likely to sell during periods of market volatility. While dividends can have a predictable impact on stock prices around their ex-dividend dates, the broader market context and investor sentiment also play crucial roles. Understanding these dynamics can help you make informed investment decisions and optimize your portfolio for your financial goals. Let's dive into what are dividend reinvestment plans, commonly known as DRIPs. DRIPs are a powerful tool for long-term investors looking to compound their wealth. A DRIP is a program offered by companies that allows shareholders to automatically reinvest their cash dividends into additional shares of the company's stock, often at a discount from the current market price. This means that instead of receiving cash payments, shareholders receive additional shares. One of the primary benefits of DRIPs is that they allow investors to harness the power of compounding. By reinvesting dividends, you can acquire more shares of the company over time, which in turn generates more dividends. This compounding effect can significantly accelerate the growth of your investment portfolio over the long term. Another advantage of DRIPs is that they enable dollar-cost averaging. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of the share price. With DRIPs, since dividends are reinvested automatically, you buy more shares when prices are low and fewer shares when prices are high. This strategy can reduce the average cost per share over time. DRIPs are typically offered without commissions or fees by many companies, making them a cost-effective way to reinvest dividends. This is especially beneficial for small investors who may not want to incur transaction costs each time they reinvest their dividends. It's important to note that not all companies offer DRIPs, and participation in a DRIP is usually optional. If you're interested in participating, you'll need to enroll in the program through your brokerage account or directly with the company's transfer agent. However, DRIPs aren't without drawbacks. One consideration is that reinvesting dividends through a DRIP can complicate your tax reporting. While you won't receive cash, you're still responsible for paying taxes on the dividends reinvested. This can result in a tax liability even if you haven't received any cash. DRIPs can be a valuable strategy for investors looking to build wealth over the long term. They offer the potential for compounding returns and can help smooth out the effects of market volatility through dollar-cost averaging. However, investors should weigh the benefits and drawbacks carefully and consider consulting a tax advisor to understand the tax implications of participating in a DRIP. Now, don't just learn about dividends and do nothing about it. Put your knowledge to work by starting to invest in dividend-paying stocks. Building a dividend stock portfolio isn't just about generating income. It's about creating a sustainable source of passive income that can grow over time. To get started, you need to learn how to build a balanced dividend stock portfolio. And this video is the perfect place to begin. We'll explore this topic in detail, discussing strategies to diversify your portfolio, identify high-quality dividend stocks, and manage risk effectively. See you there.